Welcome to our deep dive. Today, we're looking at a company making a really profound strategic choice, Cencora. It's quite a radical trade-off, actually.
That's right. They're one of the world's largest healthcare solutions organizations, and they're essentially giving up some portfolio breadth to double down completely on specialty pharmaceuticals.
Yeah, that complex, high-margin potential. So this isn't just, a standard quarterly review we're doing. It feels more like a blueprint for surgical corporate focus, high-stakes stuff.
Absolutely. And our mission today is really to analyze Cencora's fiscal 2025 fourth quarter results, plus these huge strategic decisions they announced back on November 5th, 2025.
So the core takeaway for you, the listener, what should you be focusing on?
It's understanding why this radical transformation gave management the confidence to actually raise their long-term growth guidance, and crucially, how they plan to hit those targets.
Which seems to be all about centering everything around these high-margin specialty services and logistics. And the confidence for such a massive pivot, it really has to come from a strong financial foundation, doesn't it?
Oh, for sure. Their adjusted diluted EPS growth hit, a pretty robust 16% for the full fiscal year 2025.
Right. You just don't attempt to go all in on a complex new strategy like this unless you have that kind of financial momentum, that leverage behind you. Okay, so let's unpack those foundation numbers first.
Yeah, let's start with the big picture numbers.
Yeah.
The ones that sort of validated the strength they had going into this pivot. So, full year fiscal 2025 consolidated revenue grew 9.3%. That's up to $321.3 billion.
Okay.
And critically adjusted operating income, AOI we call it, grew 15.8% to $4.2 billion.
15.8% AOI growth. I mean, just to put that in perspective, what does that tell us about their operational health? Because, 9.3% revenue growth is good, but 15.8% operating income growth. That suggests they're getting much better at turning revenue into actual profit.
Precisely. It signals strong operating leverage, probably better contract management too, especially on the distribution side.
Right.
And it gives them the fuel they need, really, to fund these big multi-year infrastructure investments they're now committing to.
Okay, now here's where the story gets, I think, really interesting. The U.S. Healthcare Solutions segment. Their quarterly operating income in Q4 surged by 25.1%.
Yeah.
That 25% growth is huge. How much of that is purely organic core momentum, and how much maybe comes from recent acquisitions?
Well, the strength is definitely there, and it's directly tied to specialty products, specifically distribution to health systems and physician practices.
Okay.
And we saw a pretty significant tailwind from those popular GLP-1 products.
Ah, the new diabetes and weight loss drugs. We hear about them constantly.
Exactly. Management noted they contributed about 50 basis points to U.S. revenue growth just in the quarter.
Can we pause on that GLP-1 impact for just a second? I mean, the demand surge is obvious, but for a distributor like Cencora, what does it really mean? Is it just handling high volume, or is there something more strategic there?
It's both, really. They certainly benefit from the massive volume, no question. But maybe more importantly, these are high-value products. They often need more specialized inventory management, different distribution protocols than, say, traditional generics.
Right, more complex.
Yeah. So it positions Cencora as a key partner for distributing the newest, most impactful drugs.
Oh.
And that strengthens their position with the pharma manufacturers.
Makes sense.
But, what's perhaps most impressive here is the core resilience. Even if you take out the recent acquisition of Retina Consultants of America, or RCA,
Okay.
the U.S. segment still grew AOI by 13%. 13%.
Wow, okay.
And they managed this despite some pretty notable headwinds. There was a $15 million drag specifically linked to sort of residual COVID effects, believe it or not. And they lost a key oncology customer that got acquired by a competitor.
So core resilience on the U.S. side seems rock solid then, fueled by that specialty demand. But how did the international segment fare, especially compared to that, roaring U.S. engine?
Yeah, international healthcare solutions was, noticeably weaker. And that's actually part of the story behind this pivot.
Ah, okay.
Q4 operating income declined 2.0% as reported. On a constant currency basis, it was actually down 6.0%.
Ouch.
Yeah. And this weakness was largely blamed on, persistent operational challenges and, frankly, massive underperformance in their specialized consulting services business, PharmaLex. That business was just becoming a drain on resources and management time.
So PharmaLex was the main issue internationally.
Largely, yes. But, to be fair, Not everything overseas struggled.
Yep.
Other international bits, specifically their European distribution business, Alliance 3PL, and their global specialty logistics arm, World Courier, they actually rebounded, showed profit growth in the quarter,
Okay.
which kind of validates the decision to keep the strong parts of that international segment. Yeah.
Right. But that weakness in Pharmalex, it really sounds like maybe the painful catalyst that forced the discipline we're now seeing play out. They took a truly massive charge related to that business in Q4, didn't they?
They did. That's
Yeah.
the really dramatic event that underscores this whole pivot. They booked a painful $724 million goodwill impairment charge
Right.
just for Pharmalex in Q4.
$700 million. Wow.
Yeah. And that wasn't just, some accounting adjustment. It was a real wake-up call, a realization that their diversification attempts into non-core consulting, well, they just weren't delivering value. In fact, they were actively hurting the overall P&L.
So that forced the issue.
It forced the immediate disciplined review of the entire portfolio. No question.
Okay. And that portfolio review leads us straight to this new core strategy. The company is now focusing on 3 growth priorities: leading with market leaders, enhancing patient access, and just relentlessly strengthening their position in specialty.
Precisely.
And to achieve that level of kind of singular focus, they decided to, clean house.
That's exactly it. They did this thorough portfolio review, as they called it, to sharpen their pharmaceutical-centric strategy. And the new rule seems pretty simple. If an asset doesn't provide a competitive advantage to the core human health business, it goes into this new financial reporting category they just created called Other.
Other. Okay. And what happens to the businesses in Other?
Well, for these assets, they're explicitly exploring strategic alternatives, which basically means they're actively looking for new owners or partners.
Yeah.
They're on the block.
Okay, so what key businesses, maybe even profitable ones, were deemed non-core and ended up in this Other category?
There are 4 main groups slated for potential divestiture. And this is where you really see the commitment to focus becoming starkly clear.
Right.
First, MWI Animal Health. Now, this is apparently a fantastic business, but it represents nearly 70% of the entire Other revenue group.
70%. Wow.
Management stressed it's strong, but its operations just don't share competitive intelligence or create synergies with the core human health specialty distribution business. So it has to go.
Okay, that's a big one. What else?
Second, their equity investment in ProPharma down in Brazil. That's about a quarter of the Other revenue. Third, some legacy U.S. consulting hub services, sort of non-essential stuff that doesn't fit the new model.
Right.
And fourth, components of Pharmalex. The parts that weren't delivering value are being shed, leaving only the hopefully profitable and strategic pieces.
Let's focus on MWI Animal Health for a moment. Selling a profitable asset that makes up 70% of the divestiture pile. I mean, that's not an easy call. What does that tell us about Cencora's commitment to specialty?
It tells you they're willing to actually reduce their overall revenue, shrink their diversification profile, and give up a steady, strong business, all to achieve tunnel vision.
Wow.
They've clearly realized that management time, capital, resource allocation, it all needs to be 100% focused on capturing this explosive growth and, frankly, the complexity of human specialty pharmaceuticals. MWI, while great, was deemed a distraction that wasn't feeding that core engine.
Got it. And regarding Pharmalex, after taking that huge $724 million hit, how are they simplifying what's left to make sure it actually supports the core now?
Yeah, they're drastically simplifying the remaining business. They'll now only focus on 3 core areas where they believe they're market leaders: pharmacovigilance, market access, and regulatory affairs.
Just those 3.
Just those 3. They're moving all the other Pharmalex service verticals into that Other bucket for strategic review. It just ensures the remaining piece is lean, focused, and truly supporting that core specialty drug pathway.
Okay, so that focus, it frees up capital, frees up management attention, and the company is immediately directing that cash towards growth opportunities. The first major area seems to be the Management Services Organization, or MSO platform.
Yes, the MSO strategy is absolutely critical. It's key to strengthening their specialty leadership because it embeds them deeper with the specialty providers themselves. It moves them beyond just being a distributor, you see.
Right, more integrated.
It's exactly. Key investments here include that acquisition of Retina Consultants of America, RCA, which closed back in January 2025, and also their pathway to eventually taking full ownership of OneOncology.
So what are the actual benefits of consolidating these MSOs? What's the immediate synergy they're seeing that makes this margin accretive?
Well, management highlighted that the main value proposition is really about making care easier. easier for patients and easier for physicians.
How so?
The internal synergy comes from leveraging capabilities across these different platforms. So, for example, sharing clinical trial expertise. They noted that RCA's clinical trial sites have actually exceeded financial expectations,
Oh, interesting.
and they're helping attract new medical fellows, which is great for them.
Okay, that's the clinical side. What about the operational side? For, a busy specialty physician, what does this MSO structure actually take off their plate?
That's key. It standardizes and centralizes a lot of the back office functions. Critically, things like revenue cycle management, RCM, and compliance.
Okay, the admin burden.
Exactly. Think about the administrative load a specialty physician faces. Billing for complex drugs, dealing with insurer appeals, navigating all the compliance regulations. It's a nightmare.
Yeah.
So by centralizing RCM, Cencora lets the physician spend much more time focusing on patient care and way less time dealing with billing headaches. That efficiency and standardization is a key driver of the overall margin lift.
Got it. So beyond the MSO, which is sort of the high-touch service side, they're also making these massive infrastructure investments. For the physical distribution of these complex specialty drugs, you mentioned, what, $1 billion through 2030?
That's right. They announced a huge commitment, $1 billion in capital expenditures planned through 2030, all to amplify their U.S. distribution network.
And what does that billion buy them?
It includes opening a second national distribution center and, critically, expanding their existing specialty distribution capacity, which really means increasing cold chain storage.
Cold chain. Okay. $1 billion is quite a statement. Is this kind of investment necessary for, standard pharmaceutical distribution? Or is this a direct bet on the future of medicine?
Oh, it is absolutely a bet on the future. Standard drugs, pills and bottles, they don't require this level of infrastructure.
Right.
This investment is necessary because specialty pharmaceuticals, particularly biologics, vaccines, and that whole upcoming wave of cell and gene therapies, they are extremely high value and very temperature-sensitive products.
Okay.
They require sophisticated, verifiable logistics. That's what we call cold chain storage. It's needed to maintain efficacy all the way from the manufacturer right up to the patient. That $1 billion, that's them future-proofing their core advantage in handling these complex medicines.
And amidst all this change and elevated spending, they're also showing commitment to shareholders, which must be important when you're taking on this much CapEx.
Yes, definitely. They announced their 21st consecutive annual dividend increase. They raised the quarterly dividend by 9%.
21st consecutive. Impressive.
It is. And that 9% increase aligns directly with the low end of their newly raised long-term adjusted diluted EPS growth guidance. So it signals confidence.
Makes sense.
Furthermore, their capital expenditures for fiscal 2026, the coming year, are expected to be around $900 million. That elevated spend directly reflects this push for digital transformation and the big infrastructure investments we just talked about. They're clearly backing their strategy with serious money.
Okay. So all of this performance track record, this strategic focus, the underlying industry fundamentals like continued innovation in specialty drugs, positive demographic trends, this is what's leading them to actually raise their long-term guidance. Let's nail down those new targets.
Okay. They raised the long-term adjusted operating income, AOI, growth guidance to a range of 6 to 9%. That's up from their prior range, which was 5 to 8%.
So a full percentage point bump on the range.
Yes. And this increase is specifically driven by higher expectations for that strong U.S. healthcare solutions segment, which is now projecting 6 to 9% AOI growth on its own.
Okay. And overall EPS?
Overall, long-term adjusted diluted EPS growth is now projected to be in the range of 9 to 13%.
9 to 13% long-term. And looking ahead, just for fiscal year 2026 specifically, what's the expected adjusted diluted EPS growth then?
For the upcoming fiscal year, they project adjusted diluted EPS in the range of $17.45 to $17.75.
Okay.
Which represents about 9 to 11% growth year over year. And consolidated AOI growth is expected to be 8 to 10%. Management expressed, pretty high confidence in these ranges precisely because that core specialty business is showing such high resilience.
Right. This level of projected growth, it does seem highly durable, especially when you look at how that specialty business is performing compared to the maybe more traditional generic and brand distribution business. Is specialty truly the key to margin durability in the coming decade?
That really is the key insight you can extract from these sources, yes. Specialty AOI growth is highly accretive to margins. It confirms that the strategic path is, likely the correct one.
So it's not just growing faster, it's growing more profitably.
Exactly. And they mentioned they've rebalanced contracts over time so that now all parts of the business brand distribution, generic distribution, they all yield a fair return.
Ah, okay. So they fixed the base business too.
Right. Which means that the explosive growth and those higher margin services coming from the specialty MSO strategy, they aren't just offsetting losses elsewhere. They're actually stacking on top of an already stabilized and profitable base.
Got it. So the MSO model, that high-touch service model we talked about, that's the mechanism for the margin lift.
Absolutely. They
Yeah.
explicitly link the strength of the MSO strategy as, end quote, the natural evolution of our highly successful specialty business to offer more services.
Mm.
And those services like centralizing the billing, the RCM, the clinical trial support, they are inherently higher margin than just, moving boxes from point A to point B.
Mm.
It's all about wrapping valuable services around the product distribution itself.
Okay. So this deep dive really reveals a company making a profound decision, doesn't it? Narrowing the focus significantly to hopefully expand the future. By prioritizing this high growth, high complexity, high margin specialty pharmaceutical space, and importantly, shedding profitable but non-core businesses like MWI Animal Health, they're effectively moving up the healthcare value chain, placing an immense bet on their logistics and service capabilities.
Exactly. The core belief driving the divestiture of even strong non-core businesses is this conviction that by prioritizing these high-growth areas, they can deploy capital and, just as importantly, management resources much more effectively.
Right. Focus.
That surgical focus ensures they are, theoretically, perfectly positioned to handle the rising complexity and the massive demand for innovative specialty treatments that we know is coming.
So wrapping this up then, what does this all mean for you, the listener? You've seen the confidence reflected in their raised long-term guidance. You've seen the immense $1 billion investment commitment to future-proof their logistics. They are betting very heavily on the sustained growth of complex specialty medicine.
Yeah, and this raises, I think, an important question for you to consider. With Cencora grouping several strong businesses like MWI, Animal Health, and ProPharma into this other segment specifically for divestiture, they are intentionally reducing the breadth of their portfolio, all to maximize profitability and focus.
Right.
So, for the long term, how does this sharp concentration risk in specialty, as profitable as it may be right now, how does that change the fundamental risk profile of the company? What's the real trade-off here between absolute focus and perhaps the necessary diversification needed to weather unexpected changes in what is, after all, a very dynamic healthcare market?
A crucial question indeed, something for you to think about. That's all for this deep dive.